Sometimes investments go wrong. So today, the Wealth Circuit investing portfolio experienced probably our single largest loss in a single day from a single stock. So I wanted to share that with you because what this channel is about integrity. It's about being forthcoming. And if I don't share the failures with you, then I'm not being honest with you, first of all. But secondly, I think there's a lot that both of us can learn from when we fail. So today I want to talk about the investment in Lamb Weston. What happened and what are we going to do about it? Hey guys, Kevin Burgess back again with another video. This is an important video today because we learn most when we fail. So I want to share with you this particular investment, what we're learning from that and what we're going to do in the future. But before I go there was a book that I read. It's called The Psychology of Money by Morgan Housel. There were 12 major takeaways that I took from that book. And I want to share 4 of those with you today because I think they are very applicable to the Lamb Weston investment. And I'll take them in reverse order. So takeaway number 11 from this book called Psychology of Money is that successful investing is not about how smart we are, but about how we behave. He points out that there's at least 2 sides to money and investing. One of those is the mathematical side, and we've been taught the mathematical side. We understand about income statements, balance sheets, cash flows, and how all of that operates together. That's the math. There is also an emotional side to investing, and we're not taught enough about this psychological side where we have emotions and nuance. The second takeaway from that book I want to share with you is that success and failure are lousy teachers. Success teaches us that we can never fail, and failure teaches us that we are bad investors. Neither of those are true. We need to find balance in our investing strategy. Takeaway number 3, actually there's number 3 on this video as well as in the book, and that is that we should leave room for error. There's never a moment that we're so right that we can bet every chip on the table. So we should never go all in on an investment. And he points out that we should follow Benjamin Graham's concept of margin of safety. And I'm going to put a video at the end of this video on a book that I read called Margin of Safety. So I will share that at the end of this video. If you've not seen that, you will not want to miss that because it applies a lot to what we're going to talk about today. And the 4th concept from this book that I want to share with you, it's actually the number 1 concept that I took away from that book. It is don't be afraid to make mistakes. He points out that you can be wrong half the time and still make a fortune. Nobody makes good investing decisions all of the time, and we don't have to. He points out that it's the decisions we make while everybody else is going crazy that defines who we are as investors. We're kind of like pilots or police officers who have many hours of boredom interrupted by moments of sheer terror. So let's don't be afraid to make mistakes. But when we do, let's make sure that we are assessing those mistakes and learning from them so that we don't make them again in the future. So I want to share with you today what I have learned from this investment in Lamb Weston. So this is a screen capture from the market today. At a particular time, and it doesn't say even what the time is, Lamb Weston was down 28.06%. This is one day. There was a one-day drop of nearly 30%. So why are we looking at this? Why don't we just look away? It's really hard. It's kind of like watching a traffic accident. You just can't look away. So we're going to look at this and we're going to learn from what we did, because learning from our investing failures helps us grow as investors. So let's take a look at what happened. Lamb Weston reported earnings far worse than any analyst had imagined. Their sales declined by 5%. Their adjusted net income and earnings per share declined by 40%. They had falling demand that created excess industry capacity, causing lower pricing. We had identified early on that in our due diligence that that this was a commodity product. They were not a name brand. They didn't have a name brand in the retail market. They were a commodity business, that their biggest risk was commodity pricing. And that we have found that risk actually turned up to bite us here in this quarter. We found that they had no pricing power when the demand for product decreased, creating excess capacity in the market. As a commodity, every supplier was lowering their price to try to get the volume through their plants. Also, we learned that in the fourth quarter, they identified some poor quality product, and they took that product back and wrote it off. So they wrote off $40 million in the fourth quarter, and I think they're going to write off another $20 million in Q1 of 2025. Just so you know, Lamb Weston has a fiscal year end of June 30th. Most companies are December 31st, but their fiscal year ended on June 30th. This is pretty common in the agricultural area because of when crops are planted and harvested and things like that. And it's important to point out that we weren't the only ones that got this wrong. Let's take a look at Morningstar's fair value. Morningstar said that their fair value was $110 for this stock. When it closed the day prior to issuing earnings, it was trading around $78.62, which sounds like a great deal, right? They also said that they had an economic moat that was narrow, which means that they should be getting excess returns on their investment for at least the next 10 years. That's how Morningstar defines that. Also, we can see that they have an uncertainty rating of medium. This means that there's a lot of companies that have an uncertainty rating of medium. So we were not expecting a huge surprise in the fourth quarter. Also, here's a Morningstar report by Christopher Inton, who said Lamb Weston faces near-term risks on ERP and traffic, but long-term demand growth and profit are intact. Now, let's take a look at tip ranks and see how the analysts were covering Lamb Weston. You can see here there were 3 analysts, and they all rated them a strong buy. They had a price projection on average of $100.67. So there were a lot of people who were surprised by the earnings announcement today. And let me show you why this was such a big deal. Take a look at this. What I did is I put together the third quarter year-to-date numbers. These are the numbers that Lamb Weston guides us on. They guide us on sales, net income, earnings per share, and then they also guide on adjusted net income, adjusted earnings per share, and adjusted EBITDA. Third quarter year-to-date actuals I have in this file. So the guidance they gave is that we would have sales of approximately $6.6 billion, adjusted net income of $810 million, which is an adjusted earnings per share of, at the midpoint, $5.575 per share, and adjusted EBITDA of $1.495 billion. This put an implied quarter four numbers out there. I'm not going to read those to you, but you can see what those are. I then compared them to what the actual numbers were for the fourth quarter and came out with differences of $100 million, $102.3 million less in sales than they were expecting. That is a 6% reduction compared to the guidance they gave us just 3 months ago. But even worse, the adjusted net income came in 38% below what they projected it to be in that quarter. Then earnings per share also impacted by that by 39.3%. Adjusted EBITDA came in about 22% lower than what they guided us just 3 months ago. So what are the key takeaways from this investment in Lamb Weston? Let's take a look at those. Number one, we identified that the largest risk for Lamb Weston was that their product was a commodity product. As a commodity product, they have pricing pressure, and we understood that, but we believed that the capacity in the industry was causing the ability for them to actually get some pricing power. Plus, their product, French fries, is the highest margin product in the QSR restaurant menu. So it seemed reasonable that the QSRs, the McDonald's, Burger King's, Wendy's, would be wanting to sell more French fries because they are more profitable for them. So we felt that, there was a mitigation there to the commodity risk, but we found out it was not a good assumption. So we just need to be honest about it and hit it head on. So item number 2 is that we have a 5-pillar investing strategy here at Wealth Circuit Investing. And it's important, though, to recognize that some of these pillars have a lot of judgment to them. And some of you may not be familiar with the 5-pillar strategy. It's been a long time since I've talked about it. So let's just go through briefly what those are in relation to Lamb Weston. The first pillar is financials. The company has a solid balance sheet. They've been paying down debt, continued to pay down debt in the fourth quarter. And so they continue to have a strong balance sheet even after this horrible quarter. They're still profitable. They're still positive cash flow. They still have a good balance sheet. They just missed the estimate and guided us incorrectly. Pillar number 2 is capital allocation. The company has a good process for allocating its capital. There are really 4 priorities that they have. The first one is debt repayment. Second is capital investment. Third is dividends. And then fourth is share repurchases. And they have a good balance of allocating their capital. The third pillar is valuation. And we saw earlier that not only Morningstar, but also the analysts were valuing this company north of $100 per share. We were buying it in the 70s. So we felt like it was a good investment and that we had a good margin of safety, basically a $30 margin of safety in this particular investment. Pillar number 4 is strategy. And in Lamb Weston's case, they're in an industry that is capacity constrained. That means that their product, which is French fries, has demand coming at them more than they can supply, or at least at the capacity of what they can supply in the entire industry. So therefore, there is pricing power that the companies like Lamb Weston would have. What we didn't recognize was that the capacity would be freed up by lower demand. And this lower demand brought to light how much of a commodity their product is. Pillar number 5 is management. This is kind of where I think we went wrong. The management team has integrity and takes responsibility for poor performance. You could see that you could hear that on the earnings call. However, their ability to operate in a non-capacity constrained environment is clearly in question now. They were not able to forecast this erosion of margins associated with lower demand and higher capacity. In addition to that, even though their volumes were down, they produced some poor quality product, causing them to have to write off $40 million in 2024 and another $20 million coming in the next quarter. More importantly, from my perspective, management failed to update investors when they knew that things were going wrong. They failed to update investors. They could have come out and said, hey, our forecast for 2024 is not going to be close to what it is. They could have guided us sooner than they did, sooner than waiting for the earnings call to do that. That would have been a lot better in the long run than them surprising investors on their call. So where did we go wrong? I think we went wrong in trusting the management team to operate in an environment that they were not used to operating in. They're used to a capacity constrained environment. All of a sudden, because of inflation, because of lower demand, they are in a non-capacity constrained environment where they have no pricing power, and they should have seen that. They should have forecasted that, but they did not. So what can Wealth Circuit Investing do better as a result of the Lamb Weston investment? And what I will say is that we should follow the process. When we did our due diligence for this investment, it's probably been a couple of months ago, we came out with a strategy and a plan on how to incorporate Lamb Weston into the portfolio. And here's what it was. This is the original moves for the Wealth Circuit investing portfolio. We were to start a position in Lamb Weston at approximately 1% of the portfolio. Keep an eye on next quarter's earnings, which is the one we just got, to see if significant progress is made in the ERP implementation and recovering lost demand. We didn't take our own advice. We didn't follow the plan. The plan was, let's start with 1% and then look at this quarter, see how they did, and determine what to do from there. What we did is we went kind of all out. We put up to 5% of the portfolio into Lamb Weston. So what did we do today? What we did today was we backed about half of that out. I sold about half of the Lamb Weston investment, got it down to what I consider a normal weight in the portfolio, which is about 2.5%. Still not the 1% that we would have had if we had just followed the process. So let me just say this. The process is designed to try to take the emotion out of it. I got too emotionally involved in Lamb Weston, and I took the portfolio up too high for this particular investment. So I own that, and I'll fix that moving forward. It's encouraging, right, to see that the process could have helped me in this, and I didn't follow it. So that's on me. I will take that one. So if you don't have a process in place, consider following this 5-pillar approach. You can define the pillars for yourself and how you want to assess each one of those, but it has turned out to be a good process as long as I follow it. So what happened? Well, we got greedy and we fell victim to the fear of missing out. How many times have we done that before? Probably a lot. But I've been investing now for probably 47 years. And you would think at some point I would learn, but it is really difficult to get past these emotions that we have. And so I wanted to share all that with you today. Hopefully it's encouraging to you that, sometimes we just don't get it right and we don't have to. So we've already made some corrections. I'm going to hold Lamb Weston for a bit and see what happens. I'm going to leave that 2.5% there. I still think as long as the demand comes back that they can be a good investment in the long term. But here in the medium term, it's going to be kind of touch and go. I don't think there's a catalyst for them to grow significantly before we see the next quarter's earnings. I will say this, though. I believe that if the management team is worth their salt, they have baked in a very conservative forecast for 2025. It looks pretty bleak. My guess is they don't want to have this conversation again with investors. So they've scaled this back. And so I think their 25 is going to be better than what they are expecting it to be. But who knows? Even though I've incurred losses, the way I think of it is tuition on an investment, right? So I learned in this particular investment that I need to follow the process. That will pay dividends for me in the long run. So, hey, we lost money. We don't like to lose money, but when we do, we like to take a look and see what happened and what can we do in the future. So I wanted to share that with you. Wanted to full disclosure that sometimes we lose money. So if you're interested in the key points of the margin of safety video, it is going to be right here. If you've not watched that, it is well worth the watch. So I appreciate you all, and I hope this was helpful as we all try to be the best investors that we can be. So with that, I'm going to get out of your hair, and I will see you on the next one.